Imagine processing hundreds of sales every single day. You're shipping out thousands of dollars in products, and your warehouse is just humming.
Yeah, the delivery trucks are fully loaded and out the door.
Right. But you have absolutely no idea which specific customers actually owe you money.
It's a complete nightmare.
It really is. You just have these stacks of paper, a bank account that definitely isn't growing fast enough, and, absolutely no way to know whose door to knock on to collect your cash.
I mean, you're flying totally blind.
Exactly. It sounds like a total business collapse waiting to happen, but that is the exact nightmare companies used to face. Today, we are looking at the invisible digital machinery that prevents businesses from collapsing under the weight of their own sales. And, understanding this exact mechanism is the secret to passing your next accounting exam.
It's basically the absolute backbone of commercial finance.
Welcome to the deep dive to all of you in our global audience. Today, we are covering sales and purchases in a computerized accounting system, which is huge for those of you taking the FA1, FA2, and FFA/FA exams.
Yeah, it's a topic that comes up a lot.
It does. We will break it into 3 parts, look at a real-world example, and finish with 3 exam tips you can use immediately.
Students often find it a bit abstract at first, but the logic is actually really satisfying once you get it.
So let's start with a really simple definition. What is a computerized accounting system, really?
Well, it's basically an integrated setup where recognizing a sale or purchase automatically and simultaneously updates multiple financial records.
Yeah, the key word there is simultaneously.
Okay, let's unpack this. It's like posting a photo on social media. You hit post once, and it automatically updates your friends' feeds, saves to your photo gallery, and logs into your permanent archive all at the exact same time.
Oh, I love that analogy.
Right, rather than you having to mail a physical photo to each place.
Exactly. And here's something that surprises a lot of people. In these systems, sales and purchases are never recorded on a separate system and then, manually inputted later.
Wait, really? No double entry? None. The manual double handling of data simply does not exist here.
Wow. So instead of writing things down twice, the system just does all the heavy lifting instantly.
Yeah, you press a button and the ripples just spread out perfectly.
So if the computer does all the heavy lifting instantly, why is this specific digital reflex so crucial for accounting exams? I mean, doesn't the software just hide it all?
It hides it from the data entry clerk, sure, but not from the accountant. And think about the business relevance. For professionals managing cash flow, knowing your total revenue means nothing if you don't know who is at risk of late payment.
Because you need actual cash from actual people.
Right. This system solves that. And there are 2 reasons examiners love this. Here's the first. It tests your understanding of the duality of automated transactions.
Okay, duality.
Yeah. Second, it tests your ability to view one document from 2 opposing perspectives.
So what does this all mean for the person actually sitting at the keyboard typing in the invoice?
It means they type it once, and the system handles the opposing perspectives automatically.
Because examiners know that manually entering data twice is a fantastic way to lose your mind and your money.
Yeah, human error is very expensive. Since examiners love testing this duality, let's look under the hood and break down exactly how this automatic update works in real time.
Let's do it. There are 3 parts to this. Let's take them one at a time.
Perfect. Part 1 is the trigger, so the generation of the invoice. It produces the format to email a customer, and it triggers the accounting update.
Simply put, the invoice is the starting pistol.
Exactly. And once that fires, we hit part 2, which is the general ledger. The system automatically debits trade receivables and credits revenue.
Okay, but here's where it gets really interesting. This ledger only shows the total amounts owed by everyone in aggregate.
Right, it's just one big pool of money.
So how do you know who to actually chase for the cash? You can't just yell at an aggregate number.
And that's why we need part 3, the subsidiary ledger. Simultaneously, the individual customer account, say, account PPS 101, is updated.
So these are separate from the main general ledger.
Exactly. They are subsidiary ledgers just for tracking individuals.
So to bring that together, one single action generating an invoice simultaneously creates the customer bill, updates the company's total revenue, and tracks that specific individual's debt.
All in the exact same moment. It's a perfectly synchronized dance.
Abstract rules are great, but to really lock this in, let's see this starting pistol fire in a real-world scenario.
Yeah, let's look at Farida and Pierre. Farida is a sole trader making pet accessories.
High-end dog collars and things, right?
Exactly. And Pierre is a pet shop owner. So it's January 1st, 20x1. Pierre orders 100 dog collars at $5 each.
So $500 total.
Right. and he gets 60 days credit. Just to keep it simple, we are completely ignoring sales tax and brought forward balances.
Got it. So step 1 is the sale. Farida delivers the goods and generates the sales invoice.
Which brings us to step 2, Frida's records. When she generates that invoice, the system automatically does a journal entry.
Debit trade receivables, $500. Credit revenue, $500.
Exactly. And crucially, simultaneously, Pierre's individual account is updated.
Okay, step 3 is the receipt. Fast forward to January 15th, and Pierre pays early. Farida matches the receipt in her system.
And the system automatically debits bank $500, credits, trade receivables $500.
And Pierre's individual account drops to nil. So for our younger listeners, that's the simple A to Z flow of an invoice turning into bank cash.
It is very clean. But step 4 is the mirror image.
Let's flip the perspective. What's fascinating here is that Pierre gets the exact same document.
The very same PDF. But he calls it a purchase invoice.
Because he's the buyer. So step 5 is Pierre's records. His system debits purchases $500 and credits trade payables $500.
Yep, and it simultaneously updates Farida's supplier account, say vendor F8421. So when he pays, his system debits trade payables $500, credits bank $500.
And Farida's supplier account drops to zero. For the senior professionals listening, this is how you manage those massive accounts without manual reconciliation.
It all just hums along in the background.
And that right there is exactly what the examiner is testing when they ask about the simultaneous update of general and subsidiary ledgers.
It sounds perfectly synchronized, but this exact mirror image is where students stumble under exam pressure.
Oh, absolutely. So let's look at what students get wrong. The single biggest mistake is forgetting the mirror image. They fail to realize that a sales invoice for the seller is the exact same document as a purchase invoice for the buyer, just processed in reverse.
And there's a big metacognitive reason for this. In our daily lives, we think of buying and selling as totally different activities.
Yeah, like when I buy a coffee, my little receipt feels totally unconnected to the cafe's back-end system.
Exactly. The brain naturally separates them. We forget that in corporate accounting, one single piece of paper triggers a perfect mirror reflection of debits and credits into entirely different computerized systems.
So what's the fix? Always ask yourself, whose digital shoes am I standing in right now, the buyer or the seller?
You have to anchor your perspective first.
Because if you don't, it's like remembering you owe your friend $20 for dinner, but forgetting which friend, leaving you just yelling into the void with a handful of cash.
That is a hilarious but very accurate way to look at it. To make sure you're never yelling into the void on exam day, let's lock in your strategy.
3 things. Here's number 1.
Remember the simultaneous update. The system never updates the aggregate general ledger without also updating the individual customer or supplier account.
Master the mirror image. That's tip 2. The exact same document acts as a sales invoice for the seller and a purchase invoice for the buyer.
And tip 3, track the net balance. When a payment is finally made and recorded, the trade receivables or trade payables for that specific transaction effectively net out to zero.
So remember, one action creates instant, multiple updates. The company-wide totals and the individual records move completely as one.
They're entirely linked.
For our younger listeners, you don't need to memorize a million separate manual steps. Just trust the automated flow.
And for experienced professionals, this is the invisible architecture that lets you manage global business cash flow with absolute precision.
You no longer have to imagine selling hundreds of products and not knowing who owes you money. The computerized system tracks every penny and every person instantly.
Integrated computerized systems turn a single transaction into a perfectly synchronized update across all your financial records. That's the takeaway.
Next time you buy something online, ask yourself, what automated invisible ledgers did my click just trigger on the other side of the world? It's pretty wild to think about. Thank you to our global audience for joining us. If it's helped you, please follow us on Spotify and leave a review.
Thank you for listening.
Thank you for listening.